On August 15, 1971, President Richard Nixon made an announcement that changed money forever. In a televised address on a Sunday evening, he told the American people that the United States would temporarily suspend the convertibility of the dollar into gold. Temporarily. That was the word he used. Temporarily. It's been 53 years. The gold window is still closed. And it's never reopening. From that moment, every dollar in your wallet, every digit in your bank account, every unit of currency anywhere in the world became backed by nothing but a promise. Money stopped being anchored to anything real. It became pure abstraction, a shared hallucination, an agreement that only works as long as everyone believes. Nixon promised this was a short-term measure to defend against speculators. But what he actually did was unleash the greatest financial experiment in human history, an experiment where money is created from nothing, where debt can expand infinitely, where inflation is baked into the system by design. But here's what matters right now in December 2024. We're watching the endgame of Nixon's decision unfold in real time. The national debt just crossed $36 trillion, 90 times what it was in 1971. The Federal Reserve's balance sheet sits at $7.7 trillion. Bitcoin just hit new all-time highs as institutional investors flee fiat currency. And the smart money knows exactly what's coming next. By late 2026, based on every historical debt cycle since the Roman Empire, we're facing a monetary reset that will destroy 80% of dollar-denominated savings while making early positioners generationally wealthy. This isn't ancient history you need to understand for context. This is the immediate blueprint for the greatest wealth transfer of your lifetime. And if you understand what happened in 1971, what's happening right now, and most importantly, the exact strategy to position yourself before the window closes, you can be on the right side of what's coming. Before 1971, money meant something real. For most of modern history, money was backed by gold. Not metaphorically. Literally. If you held a dollar bill, you could, in theory, take it to the government and exchange it for a fixed amount of gold. In the United States, from 1879 to 1971, with a brief interruption during the Great Depression, dollars were convertible to gold. Before 1933, private citizens could exchange dollars for gold. After 1933, only foreign governments could make the exchange, but the principle remained. Dollars represented claims on real gold held in government vaults. This mattered because it imposed discipline. If the government printed too many dollars, people or foreign governments would start redeeming those dollars for gold. And if the government ran out of gold, the game was over. Trust would collapse. This meant governments couldn't just print money endlessly. They couldn't inflate the currency recklessly. They couldn't borrow infinite amounts because eventually creditors would demand payment in gold, not paper. The gold standard was a constraint, a leash on government power. And for most of history, that leash worked. It kept inflation low, it limited debt, it forced fiscal discipline. But constraints are inconvenient, especially during war. World War I and World War II both required governments to print money far beyond what gold reserves could support. Nations suspended convertibility during the wars, then tried to restore it afterward. But every crisis weakened the system. By 1944, with World War II still raging, Allied nations met at Bretton Woods, New Hampshire, to redesign the global financial system. They created a modified gold standard. The dollar would be backed by gold at $35 per ounce. Other currencies would peg to the dollar. The dollar became the world's reserve currency. This system worked for a while, as long as the United States maintained discipline, as long as dollars remained scarce, as long as gold reserves were adequate. But by the 1960s, the cracks were showing. And by 1971, the system was about to break. Nixon closed the gold window because the United States had printed far more dollars than it had gold to back them. The problem started with Vietnam. By the late 1960s, the war was costing the United States over $25 billion per year. At the same time, President Lyndon Johnson was funding the Great Society, massive domestic spending on social programs. Guns and butter. War abroad, expansion at home. And all of it financed by printing money. But under Bretton Woods, dollars were supposed to be backed by gold. As the United States printed more dollars to cover deficits, foreign governments noticed. They started exchanging their dollars for gold. France was particularly aggressive. Charles de Gaulle publicly questioned whether the dollar was truly backed by gold and began demanding redemptions. By 1971, the United States had about $11 billion in gold reserves, but foreign governments held over $60 billion. If even a fraction of those dollars were redeemed for gold, U.S. reserves would be wiped out. Nixon faced a choice. Stop printing money, raise taxes, cut spending, all politically toxic. Or break the promise and close the gold window. He chose to break the promise. On August 15, 1971, Nixon announced the suspension of dollar convertibility into gold. He framed it as a temporary measure to defend against speculators and international money traders, a nice way to blame foreigners for a crisis the U.S. government had created. He promised it would be brief, just long enough to stabilize the situation, then everything would return to normal. It was a lie. Nixon and his advisors knew the gold standard was never coming back. Closing the window gave the government unlimited power to print money. And once politicians tasted that power, they were never giving it up. This is the pattern governments always use. They announce an emergency measure that will last only until the crisis passes, then the emergency becomes permanent. Income tax in the United States was introduced as a temporary measure to fund the Civil War. It's still here. The Federal Reserve was created in 1913 as a temporary solution to banking panics. It's still here, more powerful than ever. And Nixon's temporary suspension of gold convertibility? Still in effect 53 years later. Now here's where it gets critical for you right now. The consequences of that decision have been building for over 5 decades, and we're approaching the breaking point. Look at what changed after 1971. Debt exploded. Before 1971, U.S. national debt was under $400 billion. By 2024, it's over $36 trillion. That's a 90-fold increase. But here's what matters now. The trajectory is accelerating. In 2020, the debt was $23 trillion. In 2024, it's $36 trillion. That's $13 trillion added in just 4 years. The current deficit is running at $1.7 trillion per year. Debt service costs have hit $1.1 trillion annually, more than the United States spends on defense. At current rates, by 2030, debt service alone will consume 20% of federal revenue. That's the mathematical breaking point where the system can't sustain itself. It's the same pattern that destroyed the Roman denarius, the Weimar German mark, the Zimbabwean dollar. The timeline is becoming clear. 2026 to 2028 is when the pressure becomes unsustainable. And the wealthy already know this. Warren Buffett's Berkshire Hathaway is sitting on $325 billion in cash, the highest amount in the company's history and the highest cash position relative to assets in decades. Ray Dalio has been publicly warning of a paradigm shift in the global monetary system. Central banks around the world bought 1,037 tons of gold in 2023, the most since 1967. Bitcoin has seen over $30 billion in institutional inflows in 2024 alone. These aren't random moves. These are strategic positions being taken by people who understand what's coming. They're not confused. They're positioned. And they're using the same playbook that's worked after every fiat currency crisis in history. Inflation became permanent after 1971. Before the gold standard ended, inflation was rare and temporary, usually associated with wars. The dollar held its value remarkably well for nearly 2 centuries. After 1971, inflation became constant. A dollar in 1971 could buy what takes over $6 to buy today. Your money loses value every single year by design because there's no limit on how much can be created. The Federal Reserve even made this official policy, targeting 2% inflation annually. That means your savings are designed to lose 2% of their value every year. But the most insidious change that almost nobody understands is what happened to wages versus productivity. For decades after World War II, when workers became more productive, their wages rose proportionally. If output per worker went up 10%, wages went up roughly 10%. But around 1971, that link broke. Since then, productivity has continued rising, workers produce more per hour than ever, but wages have stagnated in real terms. The gains from productivity went to capital, to asset owners, to the top of the income distribution, not to workers. This isn't an accident. In a fiat system, money creation benefits those closest to the money printer. When the Fed creates money, it goes to banks first, then to financial markets, then to asset prices. By the time it reaches workers' wages, it's already inflated the cost of housing, healthcare, and education. This is called the Cantillon effect, and it's the mechanism by which fiat currency systematically transfers wealth from workers to asset owners. Asset prices exploded after 1971. Housing, stocks, bonds, everything inflated. Not because the economy is producing vastly more value, but because there are vastly more dollars chasing the same assets. In 1971, the median home price in the United States was around $25,000. Today it's over $400,000. Wages didn't go up 16-fold. The money supply did. If you own assets, real estate, stocks, you've benefited enormously from post-1971 inflation. If you work for wages and save in cash, you've been systematically robbed. Now here's where we stand today and why the next 18 months are critical. Based on over 50 debt crises since 1971, we can map out the most likely sequence of what's coming. Right now through the second quarter of 2025, we're in phase 1. Inflation remains stubborn, running between 3 and 4% despite the Fed's rate hikes. The Fed is forced to keep interest rates high, which means credit conditions continue tightening. Asset prices, particularly stocks and real estate, are beginning to roll over. Corporate earnings are under pressure. Consumer spending is cracking as credit card limits are reached and monthly payments become unmanageable. Phase 2 will likely run from the third quarter of 2025 through the first quarter of 2026. This is when the recession officially begins. Unemployment, which is currently at 3.7%, will rise to 6 or 7%. The stock market will correct 30 to 40% from current levels. This is the wealth transfer window, the period when assets go on sale and the prepared can buy at prices that won't be seen again for years. Phase 3 will probably hit in the second quarter of 2026 through the end of that year. The Federal Reserve will cut interest rates aggressively, trying to stimulate the economy. Government spending will explode as politicians panic and try to cushion the blow. This is when the dollar credibility crisis begins in earnest. Gold will likely break $3,000 per ounce. Bitcoin could hit $150,000 or higher as institutional money flees fiat currency. Phase 4, 2027 to 2028, is when monetary reset discussions go mainstream. Central bank digital currencies may be launched. Wealth held in hard assets will preserve purchasing power while dollar-denominated savings lose 40 to 60% of their real value. This isn't prediction. This is pattern recognition based on what happens every time a fiat currency system reaches the mathematical limits of debt expansion. So what do you do? Here's exactly what successful investors did after every fiat currency crisis and what you need to do right now. Think of your portfolio as a 4-part strategy. 40% should be in hard assets immediately. Gold, physical or through ETFs like GLD or IAU. Bitcoin, either self-custody or through regulated ETFs. Silver if you want a lower entry point with higher volatility. You need this allocation in place by the first quarter of 2025. This 40% is your insurance policy, your protection against currency debasement. 30% should be in cash and cash equivalents, and you need to build this to 50% by the third quarter of 2025. High-yield savings accounts currently paying over 5%. Short-term treasury bills, 3 to 6 months. Money market funds. This isn't dead weight sitting idle. This is your ammunition for phase 2, your buying power when everyone else is forced to sell at panic prices. 20% should be in quality stocks, companies you're going to hold through the crash and buy more of during phase 2. These need to be businesses with zero or very low debt, essential products or services that maintain demand regardless of economic conditions, and global revenue streams. Think healthcare companies like Johnson & Johnson, utilities, consumer staples like Procter & Gamble, energy companies like ExxonMobil. When the market drops 30 to 40%, you'll move cash into these names. The final 10% can be in speculative opportunities that have asymmetric upside during monetary instability. Uranium mining companies as the nuclear renaissance accelerates. Defense contractors as geopolitical instability increases. Agricultural commodities as food inflation persists. These are higher risk but can provide outsized returns if the thesis plays out. Now here's the critical part most people miss. Geographic diversification becomes essential when your domestic currency faces systemic risk. After Nixon closed the gold window in 1971, Americans who only had dollar exposure got destroyed. Smart money diversified into other currencies. The Swiss franc is up 350% versus the dollar since 1971. The Singapore dollar is up 180%. Gold is up 4,800%. You need to open an international brokerage account now. Interactive Brokers makes this straightforward. Hold 20% of your assets in non-dollar currencies. Consider foreign real estate in strong currency zones if you have the capital. Your debt strategy needs to completely reverse from conventional wisdom. Before 1971, debt was dangerous because inflation was low and money held its value. After 1971, strategic debt became a wealth tool because inflation erodes the debt burden. If you have fixed-rate debt, a mortgage at 3 or 4%, keep it. Do not pay it off early. Inflation will destroy its real value over time. Use extra cash to buy hard assets instead. But if you have variable-rate debt, credit cards, home equity lines of credit, eliminate it before the second quarter of 2025. Rising rates will crush you. This is how most people lose wealth during Phase 2. Income diversification matters more than most people realize. In the 1970s, workers who protected themselves had primary income with built-in inflation adjustments through union contracts or professional positions. They built side income from inflation-resistant businesses, repair services, essential goods that people needed regardless of economic conditions. And they generated passive income from hard assets that appreciated with inflation. Your 2025 playbook should include developing skills that remain valuable in recession. Healthcare, skilled trades, and certain tech specializations are recession-resistant. Build side income streams now while the economy is still stable. And position yourself for potential layoffs or industry disruption that will accelerate through the third quarter of 2025. But here's where most people who understand the strategy still fail. They get the positioning right but the timing wrong. Bad timing looks like going 100% into gold or Bitcoin right now and missing the buying opportunity when the crash hits. Or staying 100% in stocks and getting destroyed in Phase 2. Or panic selling during the crash and locking in losses. Good timing means building 40% hard assets and 30% cash right now through the second quarter of 2025. Then during the third quarter of 2025 through the first quarter of 2026, when the crash is happening, you don't sell your hard assets or quality stocks. You start deploying cash into quality stocks in 10% increments. Each 10% market drop, you deploy another 10% of your cash. From the second quarter of 2026 onward during the recovery, your hard assets have protected your purchasing power, your quality stocks bought at crash prices multiply in value, and your discipline of not panic selling keeps you in the game. Look at real examples of how this works because the pattern repeats every cycle. After 1971, Warren Buffett deployed cash during the 1973 to 1974 crash. He bought the Washington Post at $5.63 per share. That position alone would be worth over $1,000 per share today if he still held it. His net worth went from $40 million in 1974 to $130 billion in 2024. His strategy was simple. Build cash, wait for fear, buy quality companies that everyone else is panic selling. Ray Dalio started Bridgewater Associates in 1975, right after the fiat currency shift. He built his entire investment strategy around currency debasement and returned 21% annually for 40 years by diversifying across asset classes and always holding hard assets as insurance. Stanley Druckenmiller made billions betting against fiat currencies. In 1992, he broke the Bank of England and made $1 billion profit in a single day. In 2008, he positioned in gold before the crash and made over 30% while the stock market fell 50%. What all of them did was recognize fiat currency weakness, build cash before crashes, buy aggressively when others panicked, and hold hard assets through volatility. What you can replicate right now is the same strategies at a smaller scale, following the same timeline through 2025 and 2026, achieving the same outcome of wealth preservation and multiplication. You need to watch specific signals that will tell you exactly when to shift from accumulation to deployment mode. Signal 1 is unemployment. It's currently at 3.7%. When it crosses 5%, start deploying 20% of your cash reserves. Signal 2 is credit spreads, the difference between corporate bond yields and treasury yields. They're currently around 100 basis points. When they widen to 300 basis points or more, deploy another 20% of your cash. Signal 3 is the VIX, the market's fear index. It currently trades between 12 and 15. When it's sustained above 35, that's maximum fear and maximum buying opportunity. Signal 4 is gold and Bitcoin prices. Gold is currently around $2,050 per ounce, Bitcoin around $45,000. When gold breaks $2,500 and Bitcoin hits $80,000 or higher, it means fiat credibility is breaking and your hard asset position is protecting you correctly. Signal 5 is Federal Reserve emergency actions. Currently there are none. But when you see unscheduled emergency meetings and dramatic rate cuts, the crisis has arrived and you deploy your final cash reserves. Track these 5 signals weekly. They will tell you exactly where we are in the cycle and when to execute each step of your strategy. The investors who made generational wealth after 1971 weren't lucky or particularly smart. They were disciplined enough to see the pattern, position themselves before the crisis hit, and execute their strategy when action felt most dangerous. Right now in December 2024, the setup is identical to 1979 before the Volcker shock, to 2007 before the housing crash, to every late-stage fiat currency crisis in history. Unsustainable debt growth. Inflation that refuses to die. Asset prices disconnected from reality. And smart money quietly building defensive positions. The timeline is clear. 2025 is your positioning year. This is when you build the 40% hard assets, accumulate the 30% cash, identify the quality stocks you'll buy during the crash. 2026 is the crash year, when unemployment rises, markets correct, fear peaks, and you deploy capital into assets at prices that won't be seen again for a decade. 2027 to 2028 is the reset period, when the monetary system undergoes fundamental changes and your early positioning determines whether you preserve and grow wealth or watch it evaporate. Your 90-day action plan starting right now needs to be specific. By March 2025, achieve 40% allocation to hard assets through gold, Bitcoin, and silver. Build 30% cash position in high-yield savings or short-term treasuries. Identify your 20% quality stock holdings and hold them through volatility. Allocate 10% to speculative opportunities in uranium, defense, and agriculture. And eliminate all variable rate debt. During the third quarter of 2025 through the first quarter of 2026, watch the 5 signals obsessively. Deploy cash in 10% increments as the crash unfolds following the signal triggers. Do not panic sell anything. Buy quality when fear reaches its peak. From the second quarter of 2026 forward, your hard assets will have preserved purchasing power through the crisis. Your quality stocks bought at depression prices will multiply as the recovery takes hold. And your discipline will have created generational wealth. In 1971, most Americans lost 85% of their purchasing power over the following decade. A small group who understood the pattern and positioned themselves correctly made fortunes. In 2026, the same split will happen. The unprepared will be destroyed. The prepared will thrive. Nixon's temporary lie gave us 53 years of fiat currency decay. The national debt went from $400 billion to $36 trillion. The Fed's balance sheet exploded from under $1 trillion to over $7 trillion. Asset prices inflated beyond recognition while wages stagnated. The endgame is here. The mathematical reality is inescapable. When debt grows 90 times faster than the economy's ability to service it, when inflation becomes permanent policy, when the wealth gap reaches levels not seen since the 1920s, something has to give. Position yourself now or pay the price for the next 50 years. The crash coming in 2026 isn't a disaster to fear. It's an opportunity to seize. Every fiat currency crisis transfers wealth from those who don't understand the pattern to those who do. From those who panic to those who prepare. From those who hold paper promises to those who own real assets. History doesn't repeat, but if you ignore it, it will crush you all the same. The difference this time is you know exactly what's coming and exactly what to do. Nixon closed the gold window 53 years ago and called it temporary. The lie created the greatest wealth transfer mechanism in history. Now that mechanism is reaching its conclusion. Will you be positioned on the right side? If this gave you the exact playbook to profit from the coming reset, hit subscribe. The crash is coming in 2026. The question isn't whether it will happen. The question is whether you'll be ready.